is chapter 11, building the financial plan. So next we're going to look at planned markdowns. And this determines the percentage of markdowns each month of the total store stock. And the planned markdowns will flow into your 6-month merchandising plan. And for markdowns, you're going to use the percentages provided as a standard. So what you're going to do once you get to the planned markdown section, so it's going to have all your classifications that you just completed in your planned sales section. And what you're going to put in is these percentages. Because we don't have last year. So this is our planned markdown percentages to sales. And so what I did for these, because they can't be in, equal number of each, what I did is I went down to the example down here and I just used their percentages once again. And then that gives you your planned markdowns for everything, because you've already come up with your planned sales in the last one. And then now when you put in these percentages, it'll give you your planned markdowns. So, and once you've completed that, then we'll move to the 6-month merchandising plan. And it's going to focus on ensuring that there's enough merchandise in the store to accommodate sales. And it looks at planned sales, markdowns, and purchases. And you'll be putting in the stock to sales ratio, which we learned to determine in chapter 10. So you'll go find your planned sales from your planned sales worksheet, and then you'll take the stock on hand and you'll divide it by planned sales to get the ratio that you put at the bottom. So once again, we have our classifications. And the things we're going to fill in is we have to fill in the discounts. Our cash discounts is what we'll fill in. And then our cost of goods sold percentages. What I did for these is I put in their example. I just used the percentages that they used in their example, and I also just used their stock to sales ratio that they had given as an example, and just used those. I think that's the easiest thing we can do. So what you would do is you'd want to take whatever they had done and just fill all of those in. So you're going to fill in the cost of goods sold percentage, and then you're going to give the ratio. So just use what they've done and then put in the ratios that they've put in down below to fill in your 6-month merchandising plan. So next is our operating expenses that we are projecting, and these are all the cost of operating the business. And to get a net income, you're going to take your operating expenses from your gross income. And you can't just take a yearly number and divide it by 12, because during the holidays, you're going to advertise more and you're going to have more stock at peak times of the year. And so what you're going to do is I am going to give you a resource that you can go to, or you can go to the web and find annual expenses from another business that's similar to you, or an example that you find, and you can use those to fill in your expenses. And so they will probably give you an annual number, a yearly number, so you can take that number. So say they spend $30,000 on average in advertising. Then you would want to say, okay, which months am I going to advertise more heavily in? Because you can't just divide it by 12. So say you're going to advertise more heavily during when students come back to school. So you want to advertise heavily, say, in January or February. Or if you want to advertise around holidays, say like Easter or back to school, those different things, then figure your advertising based on that. Have a higher percentage of advertising during that time period. So you would want to fill in each of these to get, so say if our total was supposed to be 36,000, then you would want to have 3,000 per cell to get you to 36,000. And so see, if you started putting those in, it would get you to your 36,000. So you're going to have to do this for all of your operating expenses. So it'd be your advertising, any subscriptions, which you may have nothing under dues and subscriptions. Here for bank charges, you probably wouldn't have any, so you wouldn't want to include any service charge fees that may be incurred on the checking account. So sometimes you can have service charge fees, like you may have to pay a monthly fee on your account if you want to have Quicken on it. Actually, I just wouldn't fill anything in for this because both my husband and I have business banking accounts, and we just make sure to use the account that doesn't charge a fee on it. How much insurance is going to cost for the year? Now, this would be the same. Any license or fees that you've had to pay. So license would be if you have to pay a separate fee to use a certain person's product. Next is marketing and promotion. Then meals and entertainment would be if you're taking a vendor out or taking your employees out. So that would be something to think about. So then you'll put in selling salaries and wages for employees and then non-selling salaries and wages. So non-selling salaries and wages would be, say, management or someone who keeps your books, those different things. Any benefits you offer would need to go here. So professional would be any legal and accounting services that you would have. Rent, repairs and maintenance. And all these you can just try to find estimates online of what they would cost. So next is our capital expenditures. And capital expenditures are the assets purchased by the business to create a future benefit and are different from your operating expenses. They would be such things as your fixtures, your computer equipment. They can also be sold in the future to recapture cash. And they're recorded as assets on the balance sheet at the price they were purchased at. And capital expenditures is how much cash has been invested in the company, and you're going to need to know that. And it takes your startup assets and depreciates them for you for the first year, and then you have to enter the amounts per month by taking the depreciated value and divide it by 12 months. And all assets need to be depreciated because they lose value each year, and once they lose value, they're worth nothing to the company and assets. And also, if you're a sole proprietor, if you decide to use that form of a company, you will probably not have a salary, so you would just want to take draws as your salary. So most of you will probably do this. Unless you do a limited liability corporation, then you would pay yourself monthly. So the useful life has already been filled in, and then all of these assets have already been filled in. We filled them in one of the very first ones on startup expenses, so all that's filled in. But then what you will need to do is you fill in these numbers. And so it says your computer equipment, that depreciation for year one would be $1,167. So all you would do is take that, divide it by 12, and then that's the number you're going to fill in here. Same thing with your signage. And then you would do that for leaseholder improvements, for store fixtures, and for building. And then they'll fill in all the numbers for you there. So this is where I was talking about if you're sole proprietor, withdraw money out of the business and not a salary expense. And so if you are going to be a sole proprietor, you would take draws as your salary. So this is where you're going to want to put in how much you plan to pay yourself each month. So if you're going to pay yourself $2,000 each month, you're going to want to fill that in here and add that in to show how much you're going to pay yourself. If you fill that in, it's going to add it up over there. And you probably won't have investors draws unless you plan on having an investor. And you probably won't have dividends paid or land because you won't be buying, or amortization. That gets us through our capital expenditures. So looking at equity and loan amortization, the only things that we're going to fill out in this section would be C, your line of credit, and D, your owner's draw. So we did put the owner's draw in one of our last sheets, but it wasn't linked to anything else. So you would have to come back again and say, okay, I'm going to pay myself $2,000 every month, and I need to fill that in here. So you'd want to fill that in. Then the only other thing you'd fill in is what you're supposed to do is you're supposed to go to the monthly cash flow statement, and you're going to go to row 60. And if you have anywhere that you have a negative cash flow, then you're going to need to take a draw to cover that. And so say you have a negative amount of 1,000, and that's in month 4, then you're going to put in 1,000 here and take a draw. And what you're going to put in for your you're going to say 40,000 is your existing line of credit, and you're going to have an interest rate of 15%. And so that would be the only two sections that you would need to fill out on your equity and loan amortization. And next is your amortization schedule. And all the amortization schedule does is it looks at your loan payments for the year, and you shouldn't need to fill anything out on here. I think it was already filled in. If it didn't already have this 8% filled in, I would just give yourself an annual interest rate of 8% for your loan, and then it fills all these numbers in for you. And next is your monthly income statement, which we've kind of already talked about. And you won't need to fill anything in for this statement because it's all going to be generated. But you will need this. It's going to need to be copy and pasted and used in your financial plan section. And if I had put in all of these operating expenses, that would all be in here. But I hadn't put anything in all of that in. So it would fill out, this whole thing would be filled out for you on your monthly income statement. Or your monthly income statement. And then next is your monthly cash flow statement, and same thing, it should be all filled in for you. So mine is just missing because I haven't filled all the numbers in, but it generates everything for you. And this is another statement that you'll need in your financial plan. And then you'll also have your yearly end income statement that will also be in your that you'll need to copy and paste in your financial plan. And then you'll also need your year-end balance sheet. You'll need that in there as well. The last sheet that is in your template is your ratio analysis, and we'll talk about those in just a few seconds. And so each of those will be generated for you, and so you won't have to generate those. So but those will need to also be included in your financial plan. So now let's go back and we'll finish our PowerPoint. So now we're going to look at accessing capital, and it's difficult to get banks to loan money to startup companies, but the more knowledgeable you are, the more likely you will obtain the capital that you need to start your business. And fashion retail businesses need 3 types of capital. The first one is seed capital or startup capital, and this is the amount of money that's needed to open the doors, and is usually the money that the entrepreneur puts into the business or is from outside investors. Next is your working capital, and this is the money needed to operate the business, and it's the difference between your current assets and your current liabilities. And this is usually funding that you get from a bank. And then next, the last is your growth capital, and this is the money for helping a business grow or expand that you'll need later down the road, and it's usually provided by venture capital firms because it's usually a very large amount. When looking at accessing your capital, there's 2 types of funding you can get. You can get debt financing and equity financing. In debt financing, this is funds that are borrowed money and must be repaid over a designated period of time with interest and service charges and loan origination fees. So usually banks, when you're trying to get a loan from a bank, they expect you to at least invest 20 to 30% of your investment of the total amount needed. So remember on that first form when we're putting in, I was going to take a loan for $115,000. So you need to make sure the amount of money that you're putting in is at least 20% of that. And also, to start a business, it usually takes around $150,000 to start a business. So that's one thing you want to do is make sure that your initial money that you're going to put in is close to $150,000. And equity financing, this is personal investment, and this can be by you or by an investor that is not repaid, and the investor, what they get is profits from the company. And some sources of funds would be family and friends, and this would be equity financing. The book and in general kind of says, not to use family and friends unless you have to. and you want to put written agreements in place that outlines the expectations of you and the lender. Next is credit cards can be used, and this is a form of debt financing, and it's a convenient source of funding because they are easy to get, especially if other avenues have failed, such as getting a bank loan. However, they have the highest interest rates and they're difficult to pay off. Next is commercial banks, and they would be debt financing, and they represent the greatest source of funding for entrepreneurs, and this is where you want to try to get your financing first. And if you go through the Small Business Association where you live, you have a better chance of getting a loan from a bank because sometimes they can offer to repay a portion of your loan to the bank if you default on your loan. You can also get a micro loan program, and these are small loans. They're usually around 40,000 or under. They're used to start up or expand a business, and interest is high on these, and they're required to be paid off in a shorter period of time. And next is a line of credit, which was one of the things, remember we said if you had a negative cash flow, you would have to get a line of credit. And I said to put in 40,000 at like a high interest rate. And this is a short-term loan that provides cash flow for the day-to-day operations of a business. And the bank specifies an amount that can be drawn when needed, like a credit card, and it's used and then it's paid back in a short amount of time. And your interest is only accrued on the amount that has been used. So your loan could be for 40,000, but you're only going to pay interest on what you've used. So if you've only used 10,000 of it, you're only paying for that 10,000. Next are angel investors, and these are kind of like the show Shark Tank, where they do smaller investment amounts and they earn money on the company as it increases in value. And last are venture capitalists, and these are individuals or organizations that give really huge sums of money and get a return on their investment because they usually only invest around $1 million or more. Looking at analyzing your financials, once you get your business up and running, you need to focus on keeping the business running profitably, and the financial statements of a company let the entrepreneur know how well the business is operating. And entrepreneurs need to analyze the financial statements and use this information to make informed decisions. And one way the entrepreneur evaluates the performance of the company is through ratio analysis. And these are financial ratios that help to gauge the financial health of a company, and they're used to determine how well the business is performing against industry standards. So, for example, they can determine if you're carrying too much stock, if your operating expenses are too high, or whether you have enough cash on hand to pay short-term debt. And there's 4 different types of financial ratios. First is liquidity ratios, and they gauge the ability of the business to pay its current obligations if they come due. And these ratios measure the amount of cash or the investments that can be converted to cash to pay expenses and short-term debts. And the most commonly used liquidity ratios are the current ratio and the quick ratio. Next is profitability ratios, and they measure the profitability of a business, and they measure how efficiently a business is being managed. And entrepreneurs use these ratios to help to identify inefficient operations, expenses that are too high, and profitable margins. And the main profitability ratios that we'll look at are gross margin, operating margin, net margin, return on assets, and return on equity. And next is risk ratios, and these show the extent to which the entrepreneur relies on debt as opposed to equity capital to finance the operations of the business. And the main ratios for there will be debt to equity and debt ratios. And last are efficiency ratios, and they measure how effectively a company utilizes its resources. And the more effectively a company operates, the less it will need to access capital. And the main ratios for this will be the inventory turnover ratio and the investment turnover ratio. And now we'll look at these specific ratios. So this is table 11.1, which is on page 255 of your textbook. And it's going to show us the main 4 types of ratios and then the ratios that they encompass that I just told you about. And you'll need to provide all of these ratios in your financial plan section. And this is the last sheet in the Excel template that I showed you. So all these figures will already be figured for you. So all you'll need to do is import these into a chart into your financial plan. So for liquidity ratios, we have the current ratio, and it measures whether there's enough cash available to pay your bills. And a rule of thumb is you want a 2-to-1 ratio. So you have $2 in assets to pay for every $1 in short-term obligations or debt. And the formula for current ratio is your total current assets divided by your total current liabilities. The next liquidity ratio is the quick ratio, and it shows whether the business has enough cash to cover its short-term obligations. And the rule of thumb for this is 1-to-1. So the higher the ratio, the more stable and liquid the company is. Next are your profitability ratios. And the first one is your gross margin. And it measures the overall profit and shows how well the business is controlling its cost. And your gross margin is taking your gross income and dividing it by net sales. Next is operating margin, and it tells you how well the business is managing its overhead costs. And if operating margins are falling and gross margins are rising, then indirect costs are out of control. And the formula for operating margins is taking your operating income and dividing it by net sales. Next is your net margin, which is also part of the profitability ratios. And it shows how many cents on each dollar of sales are profit. And if net margins are falling, then the cost or the prices of your business may be out of control. And the net margin is the net income divided by net sales. Next is the return on assets profitability ratio, and it's used to compare the profitability of companies of different sizes. And an increasing return on asset indicates greater profitability, so the higher the return on assets, the better. And it's the net income divided by total assets. And the last profitability ratio is the return on equity, and it tells you whether the company was a good investment or not. So you want an increasing ROE with increased net income. And the return on equity is equal to your net income divided by your total equity. And next is the risk ratios. And the first one is the debt to equity ratio, and this measures the portion of assets that are financed by creditors to assets that are contributed by the owners. So it compares how much the business owes versus how much they own. And the higher the debt to equity ratio, the lower the chances of getting financing. And the formula for it is total liabilities divided by total owner's equity, or your total net worth. And the second risk ratio is the debt ratio, and it measures the portion of the total assets that are financed through debt. And the higher the ratio, the more debt financing the business has incurred, so you want a small debt ratio. And it's measured by taking total liabilities and dividing it by total assets. And the last two ratios are your efficiency ratios. The first one is your inventory turnover ratio, and it measures how many times the company's inventory is sold and replaced over a period of time. And you need a ratio similar to the industry, but it should not be much higher than the industry average, and it should be close to 4 usually. And your inventory turnover ratio is your cost of goods sold divided by average inventory. And last is your investment turnover ratio. And this tells you how efficiently the company uses its assets and shows how quickly and often an asset pays for itself. And the formula for it is net sales divided by total assets. And this concludes chapter 11.